And I'm going to teach you how to pay your house off faster, but also how to retain control of as much equity as possible and have as much flexibility. So you're going to control more of your money, because remember, if you pay your house off, one of the things you talked about was control, and people not wanting a mortgage, not wanting the liability and the cash flow and the uncertainty and all these different things. Well, you have that, but here's the thing.
Conversation can be pointed now kind of in the direction of maybe, what is the solution? If you have all this liability, but you have enough cash to pay off your home and you decide not to, where should the cash go?
So my mindset is finance it for as long as possible, right? For as much as, finance it for as long as possible and take as much of it as possible as they'll give you. Now, if I could be paying 3% on my mortgage and I could be earning 5.25%, in another account that's, pretty stable, pretty sound, and has good guarantees and a 120-year history of paying a dividend every year, I'm going to take that every time. You know what I mean? Hey, what's going on, cash flow hackers? It is Chris and Cole here with Life 180, and today we're going to talk to you about how to pay your house off early. Now, we're going to get into this a little bit. It's going to be a little different. We're not going to be talking about getting a 15-year mortgage or using velocity banking or using home equity lines of credit or, doing any of these, cool ways that people strategize on ways to pay off your house faster. A lot of people out there will say, make 2 payments a month because that will reduce your overall interest expense. And it's a great thing to do if you could do it. What we're going to talk about today is ultimately a way that you can pay your house off faster and regain or retain more control of your money in the process, right?
Sounds good.
So I love this because we have to think first and foremost, if we're going to be trying to pay our house off faster, why are we trying to do it? Why do you think it is that most people are trying to pay their house off quickly?
It probably has something to do with retirement, probably has something to do with net worth, peace of mind. Probably has something to do with control. Probably has something to do with we've been preached at by our parents, by our grandparents, that renting is worse than owning, and paying off your home and not having a mortgage is somehow the recipe to success.
All right, so it was awesome, and that was a loaded question, because every time you make a statement, I go, I could make an entire video on each one of those comments. I'm not going to do it right now. So here's the thing. Let's focus on the control, right? Because that's an important part of this, I think. Controlling our money. I feel like most people think that by having your house paid off, you have more control because you don't have a mortgage, right? And I guess the byproduct of not having a mortgage is maybe you have more cash flow, less overhead, less expense, less liability, so on and so forth. But what I want to tell you and really express to people is that you actually take on more liability, potentially, with your mortgage, right? Or when you pay off your house, you take on more liability. Now, Cole's from Canada. I don't know how this works in Canada.
Very similar.
Is it?
Oh, yeah.
Okay.
We have the same problems.
You do?
We have the same control problems. We just pay way more tax.
Okay, fair enough.
And as you can tell, when Chris and I get on and do this, we are so passionate about this. We prepare a little bit, but we just get on and we bring you raw, vulnerable, fairly unscripted content. So, and this is just really kind of coming from our baseline of knowledge and working with a lot of advisors, working with a lot of clients over the years. Yeah, we have the same problems in Canada as you do in the US. It's really just kind of comes down to owning your home outright, paying cash for your home. Does that put you into the promised land? Does that give you does it put you in a place that's been professed? Does it give you control of your life? Or are you better having that same amount of money equivalent put in a different bucket of income and creating arbitrage between what you're paying on mortgage interest versus, say, what you're earning on investment interest? Let's just say, what are mortgage interest rates that you're paying versus even what you're earning in these things called mutual funds?
Totally.
There's a spread there.
Totally.
I'm not a big fan of mutual funds, as you all know. But I'm a fan of arbitrage. I'm a fan of spread. I'm a fan of passive income.
Amen. And so let's talk about a couple things, because when we talk about arbitrage, And you made in a comment, like, people are trying to pay their house off early because of the fact that, their parents told them or their grandparents told them how to do it. And but in fairness, like, back then, it made more sense to pay your house off faster, because we're talking mortgage rates were 18, 20%. You know what I mean?
Yeah.
Now, when you can get a mortgage at 2.75%, 3%, 3.25%, something like that, I mean, the mortgage rates are kind of fluctuating all over the map right now, but we're still at all-time lows, really, like, close enough to all-time lows to be able to consider them all-time lows. And when you look at that, if I have the opportunity to lock in low payments, like, attached to that kind of interest rate, think about it this way. When you look at inflation right now, right, 6.2% right now, it's going to get worse, right?
Way worse.
That means if you get a 3% mortgage and we have 6% inflation, that means your cost of that, the nominal cost of that mortgage, let's say your mortgage is $1,000, just to keep it real simple for conversation's sake. That means next year, inflation goes up 6%. You're paying 3%, so there's a cost to that. Next year, your mortgage remains $1,000, but it's only going to cost you $940 in today's purchasing power, because 6% takes off $60 of the $1,000, so $9,940, right? Is all it's going to take. I think I did the math right on that.
You get the idea.
You get the concept, right? Yeah. So your mortgage becomes cheaper and cheaper and cheaper when you have a fixed rate. Now, obviously, the benefit of that is less when it's 18% mortgages in the 1980s, right?
So when the fixed rate comes up and the term renews, and it kicks in at another rate, what
that doesn't happen in the U.S.
It doesn't happen in the U.S.
No. So in Canada, so this is
you get to carry that rate forward.
So listen to this, guys. So this is going to blow his mind. So in Canada, I think you have a 5-year term, right? Or it's a fixed rate, or is it a 10-year term?
Yeah, you can do different.
Okay.
There's different. You can
so in the United
3,
States,
5,
right now, listen to this. This is ready to see his head explode. You can get a 30-year mortgage locked in at 2.75 or 3%.
You cannot do that.
I swear to God.
There's a reason why I'm in the United States right now. What?
I'm not even kidding you.
Okay.
Like, isn't this funny?
My head.
So
who's ever editing this, can you make my head explode, please?
Yeah, seriously, right? Because it's insane. Like, you can literally, why anybody? So if somebody's going to come to me and say, hey,
30-year fixed rate?
30-year fixed rate, 3% right now.
This is the ultimate hedge to inflation.
I'm telling you. I know.
Cash flow hacking. So Chris is the founder and the CEO of this concept called cash flow hacking. He was at an event, a Tony Robbins event a couple months ago, and he called me up out of the blue. And he's like, I just bought cashflowhacking.com. We're going to change the world. And here I am looking at it through as a Canadian through the lens of, and I'm getting it and I'm hearing, but I'm not connecting. You just saw me right now. I didn't know that. You just see me right now connecting with what's actually possible through this. Unfortunately, Canada, I love you, but 30-year fixed rate, we don't have this inflation hedge. That is unbelievable, because when the rates go up, and they are, so Jerome Powell was just nominated again, I think last night or today or something like that.
As chairman of the Fed.
Right, as chairman of the Fed.
Yep.
Eventually, the Fed is going to have to stop buying government bonds, government debt. And it's called tapering.
Yep.
And so when this tapering starts to happen, inflation is already 6.2. January was 1.5. It's already 6.2. This tapering, the Fed stopping the purchase of government debt will basically result in hyperinflation. It's going to go from 6.2 to whatever. Now, if you have a mortgage, still a home that's not paid off, oh wow!
I know. Like, see, here's what happens.
Cashflowhacking.com, guys.
Here's what happens.
Americans, sorry Canada.
Here's what happens. When as time goes on, inflation is an erosion of the purchasing power of the dollar, right? So what happens is inflation makes our money less and less and less valuable. And so that's why you get more of a raise. That's why they build in cost of living adjustments in Social Security. That's why, all these things are happening in the world. Like, that's why things get more expensive. It's inflation. That's it, right? It's not added value by production for the most part in the United States, because our levels of production have gone through the floor and costs have gone through the roof. So let's really think about that. It's inflation. Now, what happens is, if you can get an asset that is designed to appreciate in value, and you can fix the cost of that asset in, right? Then you're going to benefit drastically. Now, the purpose of this video, though, was not just to talk about inflation. See, we
get sucked
I told you we don't script these things.
Yeah.
So the purpose of this is how do you pay your house off faster, right? And here's the deal.
So we're basically telling you not to.
Well, yeah. So here's the deal, though. Think about it this way: if somebody's going to give me, and I'm going to teach you how to pay your house off faster, but also how to retain control of as much equity as possible, and have as much flexibility. So you're going to control more of your money, because remember, if you pay your house off, one of the things you talked about was control, and people not wanting a mortgage, not wanting the liability and the cash flow and the uncertainty and all these different things. Well, you have that, but here's the thing. I don't know if a lot of you know this, but if you have your house completely paid off, that is now an asset that you own. According to the courts, when you own your home and you have a mortgage on it, so let's say you've paid 50% of it off or 60% of it off, and you have the rest of it as a mortgage. If you had a lawsuit against you for whatever reason, you got into a car accident, a slip and fall, or whatever, and you're liable for that, and you own your home outright, that home is an asset that they can go after.
Yeah.
If you have a mortgage, you don't have an asset in the court's eyes. You have a debt.
You have a debt.
Because
you
you
have a
still
liability.
own, you have a liability.
You have a divorce.
Yeah.
And your divorce goes really, really sideways. And that divorce, there's an insolvency kind of tied into that divorce.
Yeah.
And that asset, if you have your home paid off, that asset, that house that's completely paid off is in line at the trustee. That's the top of the list. The trustee is going to go after that. Maybe you can't pay your lawyer bill. Maybe you have a really nasty divorce. The lawyer is going to go after the note on your home.
Yep.
So really, there's benefits and there's reasons why really, really wealthy people have a lot of debt, and they carry a lot of debt, and they use OPM, and they're leveraged to a very high degree.
Yep.
So yeah, I mean, this is just life. These things do happen. The conversation can be pointed now kind of in the direction of maybe, what is the solution? If you have all this liability, but you have enough cash to pay off your home, and you decide not to, where should the cash go?
Well, I know a lot of people, let's think about it this way. I know a lot of people that buy a 15-year mortgage, because in the United States, you can get a 15-year mortgage at a fixed rate or a 30-year. And for a 15-year, you get a slightly lower interest rate.
Right.
If you're going to get a 3% interest rate at a 30-year, you might get 2.5, 2.675 or something like that for a 15-year.
Yeah.
So my mindset is finance it for as long as possible.
Sure.
Right? For
0.5%?
as much as, finance it for as long as possible and take as much of it as possible as they'll give you.
Sure.
So in the United States, we have what's called PMI, mortgage insurance, basically. So if you don't, that's how they allow you to do 5% down, 10% down. They make you buy mortgage insurance because you're higher risk.
And you have to have mortgage insurance
if you have
to get a mortgage.
If you have under 20% equity, you have to get mortgage insurance, right? So here's the deal, guys. I always suggest to people, because mortgage insurance can be really cost prohibitive, and I do suggest that you get 20% equity. If you can put 20% down, do it, right? Get to that point. And if you are somebody who's bought a house and put less than 20% down in the last 18 months, go to a mortgage broker, refinance your house, because chances are it's gone up in value. You can refinance for the equity and eliminate the PMI, free up cash flow, free bonus for you. So, I mean, I've literally helped like 6 people do that in the last 2 months, and it's literally freed up for a couple of them like $600 a month in cash flow for a big home. It's pretty awesome. So what I would say to do though is, if you have a 30-year mortgage and you're thinking about paying it down faster, because a lot of people will say, oh, I got a $1,000 payment, I'm going to pay $1,100 a month or $1,200 a month just to pay it down faster, right? And so what I would say is, don't put the extra $200 a month towards paying the house down faster, because what are you doing? You're giving up control. Yes, you're opening up equity in your house, but you're giving up control of that money, because listen, if you don't have access to the equity in your home when you need it the most, period. You just don't. Anytime you have the ability to refinance your house, take equity out, control that, I'm a big believer. I know I would. Don't take that as like personalized financial advice, because I don't know your whole picture, but it's just conceptually and mathematically, it makes sense. Now, if I could be paying 3% on my mortgage and I could be earning 5.25%, in another account that's, pretty stable, pretty sound, and has good guarantees and a 120-year history of paying a dividend every year, I'm going to take that every time. You know what I mean?
And does that dividend in the face of inflation? I know in Canada the dividend, we're talking about whole life insurance companies, preferably mutually owned whole life insurance companies. That dividend in Canada mirrors inflation. So
pretty close. So there's a little bit of a tail.
But generally speaking, you can describe whole life insurance, which has been around in Canada since 1847, 200 years in the US. As inflation goes up, the dividend goes up. As inflation goes down, the dividend goes down. So when you look at a dividend scale now over the last 30 years, a lot of people say, oh, wow, the life insurance companies are paying less dividend. Well, really, on a relative basis, they're not, because the consumer price index has come down, inflation has come down, so the dividend has naturally come down. So as the dividend goes up, your hedge against inflation, your safe haven, so to speak, against the deterioration and the rotting of your money is really a whole life insurance contract. And then you get this thing called life insurance as well that solves these terminal estate issues and tax issues and various things. So do you have to can you replace mortgage insurance with life insurance?
No.
In the USA? So you can do that in Canada. You can opt out of mortgage insurance on a mortgage in Canada, and you can replace that with the equivalent amount of life insurance.
Really?
And the banks are actually happy with that.
Okay. No, you can't, because this is a function of defaulting on your morttage through losing your job. Mortgage insurance is there. This isn't mortgage insurance for life insurance. It's literally like this is what you pay the banks extra because you don't have enough equity, so the bank is taking on more risk.
So I think the disservice that mortgage insurance in Canada does to Canadians is that it's post-claim underwritten, right? In the sense that they'll assess your health, your well-being, your character after the claim has been filed, whereas with life insurance, it's pre-claim underwritten and it's guaranteed to pay out provided you're in good mental, physical health, upstanding citizen, and you qualify for it. They can't say no.
Right. So PMI is a completely different thing. It's literally the bank's insurance policy to make sure that they get their money, and it gives them extra cash flow on each mortgage with under 20% equity. That way, when the default rates go through the roof, they're more protected.
Got it.
Right. Okay. So what you were saying though, I want to go back and touch on inflation. So life insurance, whole life insurance, when designed properly, is a great hedge against inflation. Now, I'll say this, is that the federal funds rate is really what the dividend scale in a whole life policy is attached to, right? So inflation can go high, down. There are some years where we have maybe a bump, but in the past, a bump in inflation, like a big year would be like 3.5% or 4%. That's like double the target rate of inflation of 2% from the Fed, right? So we're already triple the target rate this year. And so what happens is, like, there can be years where we have a 4% year and then it goes back down to 2% or maybe a 1.5% or 1%. And like those 1 year blips are one thing. But I think what everybody's worried about right now is the fact that when you look at the economic environment, the money printing, the uncertainty, the supply chain issues, everything that's going on in the world, everybody I've ever talked to that knows economics at all is worried this is going to be a 3 to 5 year at least cycle, right? And so when you think about that, we need to realize that the only way, when you think about Keynesian economics, which I'm getting into the weeds here, but Keynesian economics is the world that we live in. And so that's when the Federal Reserve, when it was created in 1913, it was done with the mindset of creating an elastic currency, meaning when the economy is good, we can tighten interest rates, pull money out, again, because the economy is solid, it can handle it. When the economy gets weak, we reduce interest rates, and that pumps money into the economy because it makes things cheaper, right? So it helps people sustain. It's out of whack now because we hit the bottom in 2009 where we pulled, we hit 0%. The federal funds rate hit 0%. So we had quantitative easing 1, 2, and 3. And then in 2019, we started printing money and even more money. And then we had COVID happen. We printed even more money. We've literally printed over 30% of the money supply in the United States history since September of 2019.
Like it's pushing like $10 trillion.
It's insanity, guys.
Yeah.
It's insanity. And so we're dealing with this. And in whole life, what happens is right now, the Federal Reserve has to respond. We're either going to have massive inflation or the Federal Reserve has to respond and increase the federal funds rate.
They have to, and that's the taper. And that's the stopping of purchasing government debt by the Federal Reserve. The solution, the opposite, I think in one of our last videos we were playing the opposite game.
Yeah.
The opposite of Keynesian economics as described by Chris, and he nailed that, is Austrian economics.
Yep.
And so when you talk about Austrian economics, there's a boom-bust cycle, but there's no bailouts. And so we definitely heavily encourage you to Google different economic models, Keynesian, Austrian, and then the Chicago School of Economics. Look at those 3 different models, and you'll understand that naturally we're inclined through QE 1, 2, 3, 4, 5, 6. We're going to be forced to go pure capitalism, which is an Austrian economic model. We're just going to be forced into it. I won't get into how digital assets might save the day. We'll save that for another video, and whole life insurance. But the beautiful thing is that there's solutions.
There are.
Yeah.
And so what I would say, just for the sake of this video, to get back on topic, I guess, a little bit more, is that if we want to pay the house off faster, I would encourage you not to pay your house off, but to take that money, and if you put it into a properly designed whole life insurance contract, I can show you how on a guaranteed basis, you can have that same house. Even if you want your house paid off in 15 years, and that's why you took a 15-year mortgage, I did another video, and you can check it out on the link right above here, on how to pay off your mortgage. And it goes into, I actually use some calculators. I go through all of the details about a 15-year versus a 30, all the different concepts. It's about a 30-minute video. It's pretty involved, and it gets really into the nitty-gritty of the math. But I'm really big about financial efficiency, and I'm really big about, like, I believe you should have your house paid off. But how you have your house paid off is of the utmost importance for you and your financial stability and opportunity in your life and your ability to create more wealth. Because you can have your house paid off, and now you have this asset sitting there that you don't have access to any of the capital that you've worked so hard, and you're more at risk, and you don't get any tax benefits from this asset anymore. Or you could take it and you can finance it, and you can pay 3%. And let's say you have a $400,000 house. You could pay 3% on this $400,000 house and have a pile of money, $400,000, earning 4.5%, 5% over here, right? And so you get to make that 1.5% arbitrage on this 400 grand, where yes, you have your cash flow that you got to pay this, but you get tax benefits with it as well. Like if you're in a 25% tax bracket and you're paying 3%, your effective cost for your mortgage is 2.25%. You got to take off the 25%, right? So your effective cost is only 2.25%. So now you're looking at, like, you're doubling your money with arbitrage if you're earning 4.5% in a side account, right? And only whole life insurance can do that for you if you design it properly. Like, not IUL, not any of these other, like, products that you're talking about. It's important to understand, like, I don't think you should take your money out of your house, any equity, and invest it, because it's taking on risk. And so you're risking the biggest asset in your life for asset performance over here. Investment means risk. I'm talking about taking it out of here and saving it in a financial fortress that you cannot lose if you design it properly. And you know the only variable that you have is how do you fund it? And you, like, I'm a big believer, what's the upside? What's the downside? Can I live with the downside? Only make it work if you take the money out of your home, put it in the policy, look at the absolute worst case scenario, and if you can say, I'm comfortable with that result, and you look at apples to apples, that's when you do it.
Chris is saying a lot of things about assets. We're going to wrap up this video. We're going to talk about, do you want your asset to look like something liquid, something that you have control over? Do you want your asset to be at risk? What do you want your asset to look like? I think that's basically what he's saying is, what do you want your asset to look like?
Yeah.
Do you want your asset to look like one asset, or do you want your asset to look like 3 assets? Because with smart thinking, as just described, and what Chris just said, you can actually have one asset very quickly look like 3. And you're not going to get that risk factor that we talked about.
Amen. Please smash the like button, hit the subscribe, and hit the bell. That way you get notified every time we launch a new video. And make sure, check out the playlist at the end of this. I think it'll help you continue your educational journey, go down that path. And that's it. So have a blessed, inspirational day, and we'll see you on the next video. Take care, guys.